Welcome back to Bazaar Morning Call. Well, the stock of the moment undoubtedly is Bank of Baroda. It reported a very strong set of second quarter earnings. There's almost a 60% growth in the net profits, while the asset quality has also improved. The bank's return on equity is at 19.6%, which is, I think, the highest that we've seen in the last 7 to 8 years. Sanjiv Chadha, the MD and CEO of Bank of Baroda, joins us now to discuss more of their Q2 performance. Mr. Chadha, good morning and thanks a lot for joining us. You know, banks seem to be in a sweet spot at the moment with loan growth improving, credit growth back on track and asset quality situation stabilizing as well. Can you tell us what could the second half of the year look like and what's an average loan growth that you see for Bank of Baroda?
So thank you very much, Sonia. So you're right. I think the improvement has been in train for a few quarters. I think it has been led mostly by the improvement in asset quality and credit costs coming down. We have discussed earlier also that this improvement was there even 1.5 to 2 years back, in as much as the corporate credit cycle improved. Only it was obscured by COVID for some time. But now that COVID is behind us, not only is the corporate credit cycle translating into lower credit costs, but also sectors like MSME and retail loans are also improving. The second part, of course, is that what we see is a much stronger growth momentum. Even if we allow for the fact that there is some base effect because of the second wave last year, even then discounting that, I think growth is much stronger as compared to what it was a couple of years back. It is also becoming more and more broad-based. In the context of BOB, I think what is remarkable is that the digitalization agenda is something that has enabled us to decouple growth from growing the cost base. So today, BOB is number one in terms of e-stamping, e-signs. 84% of personal loans are done through digital, nearly half are MSME loans. So I think all that means that even as we go ahead, while growth happens, we are not increasing costs in tandem. Now, in terms of a question about the second half of the year, to my mind, these trends should sustain, which means that the credit costs should continue to be low. And in fact, in our case, we believe there is scope for more improvement as we go ahead. But apart from that, if we were to discount the base effect, the growth will also continue to be fairly strong. Certain supply constraints, for instance, semiconductors in the case of cars, for instance, have gone away. So I think overall, I believe that the prognosis is positive, and the valuation gap that we had seen in terms of public sector banks vis-a-vis private sector, I think that ought to narrow over the next few months and quarters.
Okay, well, just to talk a little more about the loan growth, right? I want to understand where is it coming from? Are you seeing some fresh projects being put on board? Is there fresh capex from the corporate side? What about retail? Or is it just the existing projects that are sort of pumping in money?
So as a stance, the bank had thought that we would want to rebalance our balance sheet in as much as that you would want a larger share of retail as compared to corporate. Corporate for us was nearly half the balance sheet. It is still maybe about 45, 47%. So there has been a trend for us to push retail loans faster. This quarter has been exceptional in as much as that the retail loan portfolio has grown as much as 28%. But within that, it is very, very broad-based. The second part is that home loans was a little bit of a weak point for us. Car loans were growing for many years at 20% plus. But now home loan growth is also coming through at nearly 20%. So I think growth is broad-based. For us, it is much faster in retail as compared to corporate. Partly it is we continue to maintain very, very tight discipline in terms of pricing, which is why our margins have improved along with growth being delivered. I would believe going ahead as we again look at the working capital utilization pickup, there is scope for corporate loan growth also to be faster than as what has been. So therefore, to my mind, in our case, we would expect corporate loan growth to pick up, contribute a little more, and therefore to the extent that there is a base effect that gets to some extent even out by faster corporate loan growth.
Mr. Chadha, this growth has shown up in the international business as well. Could you briefly provide some color? Where is that coming from exactly?
So I think that has been the case for us for maybe about 3 or 4 quarters. The reason is that because of the abundant liquidity in India, we found that margins in corporate in India were lower as compared to what we were able to find abroad. And having a significant footprint abroad, we had the option of allocating capital wherever the return on capital was better. So this loan growth is largely in the corporate sector. These are very well diversified. It's a very well diversified loan book because we are a relatively small player abroad, which means that you have the opportunity of picking up a lot of relatively medium-sized exposures rather than the kind of concentration risk that we run into our domestic market because we are one of the larger players there. So it has been, just to give you an example, along with growth, we have actually been able to get better earnings also. So about one year back, our net interest margins abroad used to be about 1.3%. Today, they are north of 2%. And if we also juxtapose that with the fact that in terms of cost to income, it is 50% in India and it is less than 20% abroad. So after adjusting for operating costs, the international loan book is delivering better return. So it is actually earnings accretive rather than dilutive for us.
Okay, just one final question on credit costs. Do you see it improve further? Because you just briefly mentioned that credit costs are on the lower side. But would you want to change your guidance on credit costs compared to what you said earlier?
So I think credit costs have been trending downwards. And to my mind, there is scope for it to come down further as the residual impact of COVID dissipates. We had guided earlier that credit costs should, for the bank, be between 1.25 and 1.5%. Although they are less than 1% this quarter, but there always are uncertainties. So for the moment, we have improved our guidance to between 1 to 1.25%.
To 1.25%, which is better than your earlier guidance based on what you've done in Q2. Mr. Chadha, we have more questions, but we're out of time, so we'll have to sort of take that up later. Appreciate you joining us.